Now, this looks like a lot, but they're actually going to be fairly simple. We had 3 management questions that came in via email. Stephen, second question is looking at a gain on an IBKR 75 strike call. Sold them originally at 310. What are some of the things you look at when considering to cash out some profits and roll into another position? Okay. Tom, holding 100 shares of PAYC. Cost basis is 408. Sold a May 21, 410 call. The premium was 1049. The stock started to move back up. How should I go about this trade? Alice, similar structure, but we're talking about a naked put here instead of a covered call. Alice sold on February 10th, sold a put, 90 strike put, and she got 759, and that expired on March 19th. She rolled to April 16th, then again to the 23rd, and that roll got her 20 cents of premium. Today she closed it and paid 167. Question is, did we make any money? Well, very excellent. We're going to go ahead and navigate over to the PowerOptions suite of tools. You've put these all into our portfolio tools, so we'll be able to quickly analyze these positions there to see what we have. All right, so let me just make sure the view changes for us. Fantastic. Sometimes that takes a while, but it's all okay now. All right, very good. So what we're looking at here, of course, is the PowerOptions suite of tools. I'm sorry, we're looking at the PowerOptions suite of tools here, and we're going to navigate over to My Portfolio and to the portfolio tools where you can track and manage your positions. And as you see here, I've entered in the 3 positions for Stephen, for Tom, and for Alice. The first one that we have here, of course, is Stephen's IBKR position, where we've bought the stock at 73.82, sold a May 75 for 310, made about 50% of the option premium on this position. It's currently now at 153. The original expected return is 6.1% if assigned. If the stock was above 75 at expiration, right now the total profit is 106. I have a small loss on the stock from his purchase price, about 52 cents, but we've gained 158 on the call. So, what are the 2 things I would consider when trying to take, let's say, the cash off this? Number 1, if I'm in a naked put or a covered call, normally what Ernie and myself tend to do is stay in the position until we see about an 80 or 85% profit on the premium, the 80% rule. I'll look to buy to close it at that point to maximize the return I expected or the premium I expected. If you're worried, of course, that the stock is going to be falling in price and you want to protect yourself, you might consider buying this back and then rolling down to maybe a lower strike, especially if you want to be assigned on the position. We could pocket the 150 that we've made on this position, 158 that we've made so far in the call, sell maybe a 70 or 72.5. I think it just had a 70 strike, but sell the 70 strike for a higher premium to hopefully get assigned if that was your goal. Still make the positive return that hits your targets. You could just buy to close it now and leave the upside open if you didn't want to still have it hindered by the call option. That's another choice as well. Whenever I'm tracking a position and I'm considering what could I do, we'll always go to position actions and then position analysis. This will show me where we currently stand on the position. We still have 2.1% of time premium, that remaining $30, $40, $50 or so on the call premium. Our current liquidation gain or loss, if we closed everything, Stephen, would be 1.5% after 29 days. And of course, we're expecting to get closer to that max return. The max return, was 6%. The stock stays at 73.30 in 28 days, of course. The value of the position will be 3.6% return because we didn't get assigned at 75, the max return at 6.1%. But here's an opportunity that we saw to roll down to the June option, the June 70 call. We buy the call back now for about 153. Then we could sell to open a deeper in the money 70 call, in this case for 520 going out to June. So that would make the entire net credit 678. And if we're signed at the 70 call in June, we'll have a 4.4% return. More than double what we have right now. But Still not much of a gain of what we could get in 28 days if the stock stays at 73. And if it moves back up, of course, it goes to 76, then we'd have that higher premium. Okay? All right. Now, what that does do for you, though, it gives you a higher downside protection on the position. You're getting an increased credit, so you have more protection. The break even is lowered as well based on your cost basis. And of course, you can take a look at the side-by-side picture in that case here to see what the original position is in red to what the new position is in blue. Again, we do lower the max percentage return. But I'm mentioning this, Stephen, because if you want to just take the profit off and get out of the position, you saw what the liquidation value was. It's a 1.5% return right now. The stock stays at 73 to May expiration, 73.30 roughly. You'd make 3.6% as the rest of that time value decays out in your favor. So if you wanted to get out and you were happy with the 1.5% return, you could do that. If you're looking to increase premium, right now, because the stock is between strike prices, between 70 and 75, you could roll down to the June, roll down in strike and roll out to June to get more premium, but it only puts your return up 0.8% from where you might be in 28 days. I don't know if that matches your trading goals, an extra 30 days to only gain 0.8%. Could you roll down to the May 70? Yes, but that is also going to lower the max return. It's just going to give you bigger downside protection. Could you roll up to the 80? Yeah, but it's not, you're locking in some profit now, but take a look at it. You could make another $1.50 if your 75 call expires worthless, right? You sold it for $3.10. It's about $1.50 to buy back now. So let's take a look at that. So we buy it back now at midpoint of about $1.52. So you're pocketing about $1.60. And then you could sell the 80 call for another 30 cents. Well, that means the max you could make would be 185, 190. The 150 you pocketed, excuse me, plus that additional 35 cents. I'm sorry, 150, 155, plus the additional 35 cents, puts you about 185 or 190 total. But if we just leave this alone and it expires, you get, well, right now you've got the $1.50 that's not realized. You get the remaining $1.50, so you make the full 310. The 75, if you're thinking the stock's going to stay below 75, staying in the 75 right now and getting that extra $1.50 or so decay in your favor over the next 26 days is better than trying to roll up to this to get just another 30 cents. Even though you're pocketing 150 here, then the potential is only to make 30 to 40 cents. Going down to this 70 strike here now gives you probably about 450 in premium, but you're giving up 5 points of profit to get assigned at 70, so your return would drop down. The percent return if you're assigned at 70 at May expiration, would drop down potentially lower than where you are right now. So again, as a general rule of thumb, what Ernie and I typically recommend, suggest, and look for ourselves, whether we're in a naked put or a covered call, is that we typically want to see this value go to about 80 or 85% of what we originally expected to make on the position. That's in general what we look for. You saw some of the ideas, how you can roll it down. Of course, if you're tracking it in the portfolio, Stephen, you're going to quickly be able to evaluate what rollouts you want to do. If you want to close, again, right now you could. You'd make 1.5% for about 30 days of trading. Okay, so that's a reasonable return to pocket that and then move on to a new position. One thing that I didn't check that I always would in these situations, because I don't know all the stocks off the top of my head. Oh, okay, great. You don't have to worry about earnings coming up anytime in the near future. A lot of my stocks have earnings coming up first week of May, May 6th, May 8th, May 18th, for example, that I'm in right now. If you had earnings coming up in the 1st of May, it might not be a bad idea to just take the profit off the table now if you're worried about poor earnings and worried about the stock falling, so that you don't take this 1.5% gain you have right now from a winning position into a losing position. So that's an idea as well. But as you're tracking it in the portfolio, you can see how much you've made on the premium. You can use that link to go to position actions and position analysis to see your rollout opportunities, get some ideas of why you would or would not roll the position. All right, to Tom now. Excuse me, folks. Tom, holding 100 shares of Paycom, PAYC, cost basis 408. We've got a May 21 410 call, 1049 was collected. Now, this was done about a month ago, of course, when the stock was in the 370 to 380 range. The cost base is higher because he's probably rolled positions and adjusted. He sold this call just to collect the premium. Now that the stock is coming back up, how should I go about this trade? Stock right now, as you can see, is at 399.59, and we're holding the 410 position. If you're concerned, I'm just going to go to the profit and loss chart here instead of to the position analysis. If you're concerned, I'm going to better drawing here. Let's increase this up to about 200. Get this back down. I'm sorry, folks, about 600. There we go. So in this case, if you're concerned that the stock's moving up and your call is increasing, it was, I believe, at about $15 last time I looked when I was putting these your positions in. It was about $15 to buy back, so you are losing on the call. But at the same time, over those next 28 days, as long as the stock stays below 410, the call is going to continue to depreciate in value. And I'm not so worried about it now, but if it moves up and starts to go above 410, then of course you'll be assigned. And it sounds to me, Tom, that's what you want to avoid, because you had mentioned you just sold it to collect the premium. Right now, it's not a threat of being assigned. Okay, it's still out of the money. I know it's close. But as we always talk about with credit spreads, debit spreads, naked puts, and covered calls, if you want to avoid assignment, a good plan to consider taking action to roll this call up is the 1% rule. In other words, if the stock reaches within 1% of your short call strike price, so your short call strike price, of course, is 410, 1% of that would be about $4.10. So we could just say if the stock goes up to maybe, let's say 407 or 406.90, let's just call it 407, that might be an alert you might want to set in the portfolio. So as it moves up to 407, you want to just keep premium. You just want to keep selling premium. You might consider buying to close this and then moving up to the 420 call, but you'll have to go out to June or July to potentially roll for a credit if that's your goal. Okay, right now, of course, you are down just about $5 in this case. Not too bad. Let's just take a look at where you stand right now. As we did for Stephen, we'll go to position actions and then position analysis. Let me clear out my drawings. Tom? Okay, so rollout, right now you're at a loss, it shows me, of 3.2% if we liquidate. And that's because the call premium has moved up, as we mentioned. It's currently at $14.90. So it dropped from where I saw it at 15. We were previously analyzing the position. And of course, if the stock stays at the same price over the next 28 days, we know it's going to move. But if it stays at the same price, you still have a 0.5% return when the rest of the premium decays out in your favor. There are some rollout opportunities shown. You could roll out to the May 420, but this is going to be done at a debit in a sense. Okay, so you took in 1049. You're going to pay $14.90 to buy it back, and you'd only get $12.65. Okay, so the total new adjusted net credit is $8.24. You'd be rolling for a debit, but you'd be at a higher strike where you're expecting it to expire worthless. Okay, now we can go further out, as I mentioned, to June, and this is where you could roll for a credit. Costs you $14.90 to buy this call back now. We give ourselves another 10 points of cushion to the upside, but we add another 30 days onto the position. This would give us $16.65. So we increase the total net credit on the position up to $12.24. So if you're looking to increase the premium slightly, rolling for a credit, but still staying out of the money to have the cushion, that's probably the best one here. I mean, the a 430 call would be done at a debit for June. The August 420 almost doubles your premium, takes it up to $24.59, but that's for 119 days. That's a long time period. That's 4 months in this position. So as I mentioned for Stephen, usually in general, what I'd like to do here is look at a position, where the decay works in my favor. Yours is increasing now because the stock's moving up, but it's not within that 1% range yet. You've still got a little $7, $8 cushion. In this case, look for the time decay to work with you. Maybe it might be good to buy it back in that case when you see that 80% decay. in that favor, Tom. So that's what I'm looking at here. How should I go about this trade? I can't give you direct advice. You know that. I cannot give you direct advice. I'm saying as a general rule of thumb, you're not threatened to be assigned right now. If the stock moves up to that 1% rule, goes up to 407, 406.90, you might consider rolling the position. We saw some opportunities where you can increase your net credit by rolling up to a higher strike and going further out to June. You're not increasing it by much, but you are rolling for a credit in this case to increase sort of the premium coming in on the position and enhance your downside protection slightly by the increased premium as well. But if you're worried about that, that is a good opportunity to consider. Again, you also have an August one to consider. You'd have to decide if going out 4 months is worth it to you to stay in that 420 or maybe even go up to the 430 range in that case to be able to roll for a credit, keep income, or wait on the position now, see if we can get some more time decay in your favor from the premium you sold, and then pay attention to the 1% rule. Okay, that's just the suggestions I have now is don't panic. Don't over panic. Don't try to over trade because you see your call price going up and it's moving against you. You have some time. You have a little bit of room here to work with. Think about the 1% rule and to move or analyze your position, Tom, in that case. And lastly, for Alice, February 10th, we sold a put, strike 90 on FSLR, generated 759, and that expired on March 19th. You rolled it to the 16th of April and then again to the 23rd and collected a 20-cent premium. So what I'm showing here, what does she mean by she sold the 16 put, a naked put, similar profit and loss chart to the covered call, and she rolled it, in this case, to April 23rd and got a 20-cent net credit. So I'm just recording here that we have sold the 23rd April 90 put for 20 cents. Maybe she collected $1 initially on the April 16th one, but she paid 80 cents to buy it back. Or, she paid $1.20 to buy it back and sold this one for 40. So the total net on where she is now is 20 cents from the last roll. But you see here, the effective cost per share is minus 7.79. And why that's in there is because I put in a historical transaction where we took in the 7.59 for that put that expired on March 19th. So she took in 7.59, 20 cents was taken in, so a cost basis is 7.79, but she bought it back today for $1.67. Did she make a profit? The answer is, of course, yes. And essentially, even though the prices are different now, Alice, through all the transactions that you made based on your numbers, I'm still not sure what the other premium was on that, but you said you rolled for a 20-cent net credit, so I think I'm good here. But again, you bought it back for about 167, you said. So with the current liquidation value at about 160, the profit's 619, 618. And so another 17 cents off of that, you probably made about $600 on this position total. And remember, because you took in the 759 originally and then the other 20 cents, so you have a premium in of 779, and you bought it back for 167. So yeah, that puts us at about 612 or so as the max profit that you took in on this position. You have the closed profit now of 612 roughly. And of course, as I'm tracking positions in the portfolio, not only can I see that easily, but let's go ahead and close this position. I might have an extra put in here, I apologize, but we're going to simulate closing this position, buying it back today at 167 to close the 90. That's wrong. Close the 90 put as the stock was dropping down below 90. I think it went to 180. I'm sorry, it went to 88 at 1.87. So we just closed that call, closed the put, excuse me. Now I can take a look at analysis by symbol. Okay. And FSLR originally profited 759, took a loss of 147 on this one. Considering your 20 credit, buying it back for 167, there's your total profit of $612 for the FSLR position now that it's totally closed out as well. Okay, so Alice, yes, you did make a profit on that position. I encourage you to use the PowerOptions Portfolio tools to track those positions as we saw for CVIN, so you can see the liquidation value. Related to that, Alice, you had said you bought it back for 167. So yes, on Monday, now the stock's at a different price. It's at 88. You don't want to sell the 90 if you go out again. But if we sold a put, let's say at 87, 86, you could take in another $2, another $3. But as we showed earlier, you want to make sure that you know your stock. I think you did a great job, okay? Right now, I wouldn't recommend selling another put on FSLR because earnings are coming out on the 29th in 6 days. I don't really want to be in a covered call, a credit spread, in a brand new position with earnings coming up because the stock could swing wildly one direction or the other. Suggestion might be, Alice, to wait. You've already closed this put to cancel the obligation. Wait until after the earnings on the 29th. See where FSLR stands. And if your sentiment remains the same for a neutral to bullish position, then evaluate opening a new naked put or structure trade that you want for FSLR. But I wouldn't feel forced. I wouldn't feel the urgency right now to roll it. I'd wait till after earnings because, as we know, anything can happen at earnings. And we're talking about a neutral to bullish position. I don't want to get caught in that case.